So just tell us, what's your perspective now? It's been a few weeks since you've done it. What's your perspective now, looking back on this whole process?
So before we get started, I just thought I'd say, Peter was talking about being involved in the industry for 14 years, but before we actually started funding Circle, started researching it, I used to read your blog posts actually. So I think Peter's been involved in the industry longer than probably anyone, to be honest.
Well, thank you.
I think with the IPO, the biggest feeling we have is that we're glad we got it done, to be honest.
Right.
Because it takes an incredibly long time, and a lot of people told me it would take a long time, but it probably takes longer than even I thought. And it's an incredibly inefficient process. So, if anyone wants to disrupt the IPO market, I think that would be a good one to try and do. So, you go around and you see hundreds of different people and basically say the same thing over and over again. And often, these people don't actually have that much interest in buying the shares. They're just testing some thesis on, the economy, small businesses, lending, online lending. They're trying to figure out if they should hedge their bank. So it's an incredibly inefficient process. And also, since we floated the business, there's been quite a large tech correction in the market. When companies like Amazon are down 25%, it's difficult to get IPOs away.
Right.
And then also we have this thing called Brexit going on at the moment, which has shut the IPO window. So, yeah, the overwhelming feeling is just happy we managed to get it done after all the work we put in.
Because if you delayed it a couple of weeks, you probably wouldn't have got it done this year, right?
Yeah, I personally think even a day,
really?
To be honest, yeah. If you looked at, we tried to get out before Aston Martin because they were a bit bigger than us.
Right.
And, I think that served us well. We were also the first IPO in this new process in the UK, which was also very interesting because we were effectively the guinea pig. So yeah, I think we managed to get it done with a lot of stuff going on. But I think what we're quite excited about is what we can now do now that we're public, because we've been trying to go public for a while. Well, as I said, we've been preparing for this for a year. But yeah, quite excited about the future.
So then how is life different for you personally now? You're a public company CEO. You've got a lot of spotlight on you. You can't just say anything you want anymore. You've really got to be more careful. How is life actually different for you now?
Well, I don't think you have to be necessarily more careful than we were before. But in all honesty, it hasn't changed that much. We had a listed vehicle. On the London Stock Exchange, we had a listed fund, so
right.
I was a director of that for a while. So I kind of did one IPO already. The overwhelming thing that's changed is you don't have to do this IPO anymore, which frankly,
don't have to get asked about it anymore.
Yeah, exactly as well. Yeah, and and the amount of time it took, it was like having another job. So in a weird way, I actually have way more free time now than I had before, which is nice.
Right. Okay, so let's talk a little bit about your offering and about the competition, because you see a lot. There's more. Obviously, small business lending is a competitive market. You've been going up against banks since the day you started, but there's also more digital offerings now. So, who do you view as your main competitors now?
So I think the competitors have always been banks, to be honest. I think online lending to small businesses is very noisy, and there's lots of different people doing different things, but not many people, I would say, if anyone, is really doing what we do, which is these long-term loans, low interest rates, comparable to what banks offer. And in that part of the market, we put data on it in the prospectus. We think in markets like the UK and US, we're nearly 70% market share. So I think a lot of people do different types of products and a lot of short-term stuff, but no one is really doing this term stuff. And whilst we've heard a lot of noise about banks, launching these digital offerings, I kind of talked about it last year, but I've often found it pretty confused. The one advantage I think banks have is their brands. Their brands, whilst a lot of us don't like banks, they're very much trusted. People would leave their money there. They're happy to borrow. If you go and start these digital brands, you lose the only advantage you have. I mean, we're spending tens of millions of pounds to build a brand and get Funding Circle out there and get people to know who we are and to trust us. And banks are almost just giving up that advantage. So I've often thought that it's quite confused, and we don't really see these guys much in the market, to be honest. So I think it's more noise than substance. And I honestly think that after a while, it's just a stopgap until they digitize their core product, because that's the thing that I think banks should be doing, is completely digitizing. I think Lloyds is doing a very good job of it at the moment, and actually offering through their core brand on their core website.
So you don't think these banks should be starting these new digital brands? You think they should be launching Lloyds Digital or HSBC Digital or whatever it is?
Yeah, I mean, I don't think it's a good long-term strategy, because again, you're just going to have to spend huge amounts of money to build these brands, and you're going to spend it across all these different little brands. I don't get it. So
the Funding Circle brand's more well-known than a lot of these banking brands, right?
No, I mean, you'd be surprised, actually. I mean, our unprompted awareness is around 4%, and an average bank is about 30%. So, I mean, we all live in this little bubble.
Right.
We
I
all
thought everyone
know
knew
each
what
other.
Circle was.
But no. I mean, I think it's, there are a lot of brands, especially online-only brands, Just Eat, Money Supermarket, all these kinds of brands in the UK, Quick and Loads, for instance, in the US, who've spent a certain amount of money and got to a certain amount of awareness. So,
okay. So then, you've sort of famously said that the pure marketplace is the way to go. Now, in the United States, where you have a sizable business, pretty much all of the leading players have moved away from the pure marketplace model into about some balance sheet, some marketplace, and some companies have just sort of gone completely away from the marketplace. Do you still hold that the marketplace, the pure marketplace, is the best model?
Yeah, I mean, I was in the US last week at a Fintech conference, and I caught up with all the current and former CEOs of all these platforms, and I mean, it is quite clear people have moved away from that model. I think it's a shame. I think the US was particularly affected by a lot of headwinds in 2016, and people moved away from the model, maybe out of necessity at the time. But yeah, I mean, we still believe in it. We're probably the last people plugging away at this thing. We do make exceptions in rare circumstances. So when we launch new countries or new products, we do tend to do a little bit at the beginning. But no, I mean, I'm a firm believer in the model. I think it works better when you have a high repeat customer base, which you do in small business lending. Maybe you don't have it as much in consumer. But yeah, I mean, I'm surprised there aren't more people doing it. But yeah, maybe we're the only idiots in the room, or maybe we're the smartest people in the room. I don't know, but we'll see in a few years.
Okay, so then when you look at your business now, you're in a few countries, to continental Europe, you've got the UK and the US, and obviously the US is the biggest market you operate in. It's a massive market. But where do you see your biggest opportunity going forward?
I mean, we're pretty excited about all the markets, to be honest. So I mean, even in the UK, we still think we're only about 2.5% market share from the data we've been able to get. So, and we have about 4% unprompted, awareness. So, clearly, if we can move that 4% close to where banks are, we think we can take quite a lot of share. The US we're particularly excited about. When we entered the US market, it was a real knife fight for a number of years. In the US, people raise a lot of money very quickly, and that pushes acquisition costs up, and it makes the model very difficult. But I think what the US is quite good at is they tend to clear people. Well, people tend to get cleared out very quickly. So we've emerged as by quite some distance, the largest long-term lender in the US. And actually, within the next 12 to 18 months, if you look at loans under management, which I think is the way traditional finance businesses talk about how big they are, loans under management, loans outstanding, I'd actually expect us to be the biggest online loan provider in the US within the next 12 to 18 months. So we're feeling pretty good about where we are there. And Europe has been great as well. I mean, we exited Spain following an acquisition we made in Europe. But Germany and Netherlands have worked very, very well for us. And getting close to doing 20 million a month of lending in those markets. So I do think, across all the markets, we see pretty large opportunity.
Mm-hmm. And so then it's been a while since you've done an acquisition, or since you've expanded beyond into a new market. So when can we see, and what can you tell us about how your thoughts are towards more international expansion?
Yeah, so we started doing international expansion with the US, and that was partly because we just felt we couldn't live with ourselves unless we gave it a go in the US. Right. And I'm really glad we did. I mean, we spent a lot of time on planes and
still spend a lot of time on planes. Yes.
A bit less than before, but yeah, a lot of time. So I'm really glad we did that. Europe as well. People say just don't go to Germany. There's like money on the streets. Everyone could get a loan from all these different government banks, but actually, if you're a small company, you pretty much struggle to do that. So we last did that. The last bit of international expansion was 2015, and we started to really find things a little bit difficult. We were doing a lot of different markets. We hadn't structured ourselves into a global organization. So what we did over that period was we brought on a lot of new senior hires who were used to working in multi-geographic organizations. We actually focused the business only on doing small business loans. We were doing a bit of property lending. That was working out very well for our investors, but I just didn't feel like it was a digital business. I didn't feel like we had a big advantage there. So we kind of refocused the business on just doing small business loans, trying to be the best in the world at this one thing. Mm. And the markets we're in cover 35% of global GDP. Germany, US, UK, 3 of the 5 biggest economies in the world. So we were, we felt like we should really just make sure we were going to do a good job in those markets. Right. And that's still our overwhelming focus, to be honest, is making sure we grow there. But we will enter a new country next year. We've been planning that for a while, and I think get back into the habit of doing the international expansion. Okay.
So clearly we've had a bit of turmoil here in the UK over the last week, especially. What are your customers saying about Brexit? How are they concerned about what's going on, or how is it affecting your business?
I mean, we've seen some interesting trends. So actually, in the Brexit vote, our understanding from the surveys we did was that the majority of our customers voted for Brexit. They felt that there was extra rules and regulations, that they didn't like that. Since the vote, we've pretty regularly surveyed them. We've definitely seen more of a swing towards those businesses wanting to stay in the single market and things like that. Mm-hmm. We haven't quite figured out if that means they want to stay just yet. But the biggest thing to know about these small businesses is not that many actually export, really. Right. Actually, most of them are very geared to the local economy, and whilst the UK economy has slowed a bit, we've gone from kind of the fastest growing to the slowest growing economy in the G8 or G7. It's still growing. It's not in a recession. So overall, they're doing fine.
Okay. So we had a question come in here on Slido. How do you see funding Circle in the event of a future credit cycle downturn in most of your main markets? How do you think it's going to go?
Yeah, so this was one of the 2 biggest questions we got when we were IPOing the business. The other was, you're not making money. When are you going to be profitable? And then you haven't been through a cycle. Yeah. And I think there's a few things to think about. The first is what people haven't really appreciated, and I've started saying a lot more, is that people think a lot about funding through a cycle. Mm-hmm. there's a big difference between platforms and banks. So banks will take short-term money deposits and lend it long on mortgages and things like that. So some of the biggest banks in the UK, the average funding duration is 3 months, the average lending duration is 5 years. In platforms, you actually have perfectly matched back books of loans.
Right.
So the back book of loans is not an issue that's matched, that will carry on as it is. Platforms don't run a liquidity risk. They do run a funding risk for new loans. Banks run both, and frankly, if you have a liquidity risk, you can't fund anything. In terms of a cycle, what we think will happen is losses will roughly double on historic loans. We've done a lot of stress testing. My chief risk officer used to actually run all the stress testing at Barclays Bank, so we think we know what we're doing at this in this kind of stuff. However, that will be on an amortizing portfolio of loans. So you're typically not going to get hit on a full balance. You're going to get hit on a declining balance.
Sure.
And as long as we're not just sitting around asleep at the wheel, just saying, there's no recession happening. So as we start to see the indicators, which are pretty leading in small business lending, we think we can actually adjust our models. But importantly, we actually think we can increase price as well. In the next cycle, banks will have their traditional, have to raise provisions because central banks will tell them to do that. But there's been this new concept of liquidity buffers that have been introduced since the crisis. The idea being, if we all want to go to the bank and get our money out, there isn't enough money, so let's force banks to hold more liquidity. So if you read Jamie Dimon's shareholder letters, all he talks about is this liquidity buffer. It's like, this is a nonsense, it's going to make crises worse, more pro-cyclical. So I think banks are going to be even more pro-cyclical than they have been previously. And with us, as long as we can maintain funding, which I think we can, 85% of our lending actually comes from existing investors. We actually think it's going to be a great opportunity to take share. Mm-hmm. So far from being a problem, I think recessions are going to be very, very good for businesses like ours. And it comes back to this kind of being a platform versus, balance sheet and all this kind of, my theory on it has always been, if you're a balance sheet, you end up becoming a bank because that's the best balance sheet model, the most leverage,
right.
The lowest cost of capital, things like that. So why not just be someone that isn't a bank?
Right.
Play a different game. We're not a bank. We have different regulatory structures. We have a different brand. Our brand says we're not a bank. Come and borrow. A lot of businesses like that. And I think there is space in the market for someone to be quite large doing that. I don't think you're going to put banks out of business or anything, but can you be 10, 20% of the market just doing something that's different?
Right.
Which is kind of why I despair at this kind of rush towards becoming banks. I think you're just playing the same game as these very, very big incumbents who
Yeah, understood.
have big advantage.
Okay, so we're running out of time here, but the question that's on the screen here, what is the bigger challenge? Is it attracting funding or is it customer acquisition?
It's different in different markets, depending on the maturity. So a market like the UK, where we're growing a bit slower, have a very big existing investor base, we're very happy. We probably have more funding than borrowers, but then, to be honest, we're investing to grow, and there's only a certain rate of growth you really want when you're that big as a credit business.
Right.
If you look at markets like Germany and Netherlands, we could probably grow a lot faster if we had more funding, but frankly, we're already growing hundreds of % a year, so I don't know if it's worth growing faster than that. And then the US is kind of in a Goldilocks phase in the middle, probably, I would say, where it's got funding, we recently announced a very big $1 billion deal. So it depends on the maturity of the market, really.
Right. Okay, we'll have to leave it there. Thank you very much, Samir. Appreciate it.
Cheers.
Okay.
Thanks.
Thanks a lot, man. Appreciate it.